Good afternoon, everybody, and thanks for joining us on our latest Credit Trends webinar. We're excited to be joined by James Partridge from Moody's Analytics today to give us a view of what's going to happen, not just what's been happening. Before we launch into the information, I'm going to hand this to Sandra Shep, who will give us a quick guideline on how to use the platform.
Thank you, Bill, and good afternoon, everyone. Today, you'll see a Q&A widget on the left side of your screen. Feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there are too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation is also available in the resource widget for downloading, also on the left side of your screen. Our slides today are in the middle of your screen, and our session is being recorded, and you'll receive the on-demand link via email tomorrow. We have a short survey, which we'd ask you to fill out at the end of our session. It will automatically pop up at the end of the webinar, but if you'd prefer to complete the survey at a later time, you can access it by clicking on the survey icon at the bottom of your screen. Now, let's get started. Bill, back to you.
Thanks, Sandra. And so, it's an interesting year that we're wrapping up. 2020 was certainly not what people planned for as we went into the year. And a lot of interesting things happen. And, one of the things we were talking about is this is, the biggest recession that we've ever experienced, at least since the Great Depression. And even that didn't happen as suddenly. But, when we look at a lot of other indicators, particularly for us in the credit market space, it really doesn't feel like a recession in some ways. And so, it's been a really interesting experience in terms of kind of how things have come together where, we've really been able to weather what has been a pretty strong storm through a number of different things. And when we sort of talk about recovery, we all know how big the job losses were last year, particularly in kind of April, May timeframe. We've been recovering, but in reality, we're still, over 500,000 jobs short of where we were a year ago as we started to go into the COVID period. We've actually had a bigger job loss even over this time period than we did, at the peak of the great financial crisis in 2008, 2009. And so, a fairly significant disruption to our economy and marketplace. And as you think about it, we've talked about this notion of K-recovery a number of times. There are certainly elements that really haven't recovered much at all. So, again, we all know food services, restaurants, a lot of things to do with tourism and services. And so, if you look at sort of key groups, they're not recovering at the same rate that we've seen others. And so, from a job perspective, it sort of means part-time jobs in particular have recovered much slower. There's been lots of stories about women in particular being kind of over-impacted by the effects of the economy. And you continue to see that in their employment numbers that, again, they've recovered much slower than men have. And really, young people in particular have been impacted, again, because of this service-oriented, kind of lower-income, part-time jobs. They've seen there's really slow recovery. So typically, if you were a risk manager and you saw this picture, you would expect a fairly significant impact to your portfolio that we just haven't seen kind of coming through. And really, that's got to do with the government programs that have been in place. And so there's been very few, if any, recessions that I could see where we actually saw a strong growth in disposable income at a time where we saw the maximum job loss. So we saw a fairly significant drop in employment income, as the shutdowns happened and the unemployment rate started to rise. That was really offset by programs like CERB that really were able to kind of help people get through that period with a lot of sort of those government benefit programs. And so we saw this really strong increase in disposable income, to the point where we actually saw savings really increase quickly. And, if you kind of look at, savings versus credit, since 1996, which is going a long way back, we've only had one quarter where we've actually had more savings than credit accumulation. We've had 3 straight quarters in a row now where we've had very strong increases, right? So we've seen this shift, from credit to savings that's really been supported by these programs. When we look at the number, employment income was down in the last 3 quarters of last year. If you look at sort of the unadjusted numbers, about $26 billion year over year compared to 2019. But we saw somewhere in the neighborhood of $117, $118 billion in the government benefits. So you could see where those two things weighed against each other, where we were getting a lot of money. We were gaining back money from the government subsidies, more than we were losing. And even if you account for the fact, well, employment income should have been growing, by about $30 million, it was still about a 2 or 3 to 1 ratio in terms of those dollars. And so really, really strong support made this, from a credit perspective, unlike any recession that we had really been through in the past. And so when you look at those numbers, you see savings significantly higher, and just as importantly, net worth. And so net worth has been on a really, really strong winning streak at a time where you would have expected things to be very different. If you kind of remember back to sort of this time last year, we saw those forecasts from CMHC about housing price decreases, which I don't think any of us would have been shocked if we saw some kind of decrease in house prices during the recession. You kind of think through kind of stock markets, if you think of the early days of COVID and just how badly those stock markets were hit. And we really saw that corner turned. And really, instead of seeing those declines, we've seen very, very strong, absolutely. I've avoided as much as I can for the past year to use the word unprecedented, but there's really not a lot of other words you can use. We saw this really, really strong surge in sort of personal wealth that we hadn't really seen in the past. And what that started to do is ease from a credit perspective sort of some of the stresses that were in place. So our debt to disposable income ratio was already on the decline, not in a very significant way. A lot of that was to do, we started to see slower growth in credit, kind of going through the late 2019, so that was pretty strong. But now what we've seen is this really strong rise in disposable income. And so now we've seen a fairly significant decline in the debt to income ratio. Part of it's just going to be very temporary given the nature of these government subsidies, because we have seen credit growth respond, but it's all been on the mortgage side. So non-mortgage debt continues to sort of slide and have a much lower, if not negative, growth rate. The other positive is we were starting to see some strain on debt service ratios, and so we're starting to see that ease as well, again, given that you have these much stronger disposable incomes. What we had seen as interest rates started to go up in 2017 and 2018 is particularly people with large lines of credit that were on variable rates really started to feel the strain of higher interest rates. Now we've really seen that pivot, and so we've seen this very strong decline, even though the fact that we've seen very strong growth in mortgages, we haven't really seen their debt service ratio pop back, given the income and the fact that interest rates are at such a low level. So again, this hasn't felt from a credit perspective much like a recession at all. And so when we look at sort of the underlying trends, what we do know is that, on average credit, non-mortgage debt has been going down over the last year for a number of different reasons. We're not spending the money that we had in the past. We aren't buying new cars. And even if we had the demand, in many cases, supply chain have meant that, sort of access to vehicles and things haven't been at the same rate. Auction houses were closed, so used cars were slowed down for a good chunk of last year. So we've seen sort of the non-mortgage side really kind of take the hit and really slow down and not sort of gain the same momentum we would have expected. We've also seen an incredibly big drop in bankruptcies. Again, not too surprising in the earlier stages because we knew courthouses and things were closed. I was joking with a friend of mine who runs a large bankruptcy trustee, and I said to him last summer, I hope you're getting your rest. It's going to be a busy fall. And he said, yep, like we're really gearing up. I talked to him again a couple of weeks ago, and so now we're saying you're going to be, ready for a busy spring. And so we just have not seen that return in bankruptcy that we really expected. And part of that is, again, the deferral programs and the government programs have really helped to keep delinquencies at a very low level and actually improved. Again, not something we would ever really notice in a recession in the past. And so where the strength has come from has really been on the mortgage side, and it's really driven by the fact that interest rates are at such low levels. If you start to do the math around sort of the cost of even a $500,000 mortgage, are much more affordable than would have been in the past. And in many cases, particularly in a market like Toronto or Vancouver, you're talking about rent levels at, sort of $2,000 a month. So we've definitely seen a really strong surge on the mortgage side, and we've seen a lot of markets, and, there's been lots of anecdotal conversation around, people leaving the big city and going to the suburbs because they don't need to be at home as much anymore. But whatever the drivers are, mortgage and housing has really been a key source of growth. On the card side, we have definitely seen a much slower rebound, and it really does reflect the fact that so many physical locations have been closed, and we've seen such a big shift towards the digital approach. It's much harder for cards to actually, particularly on the acquisition side, really drive volume in that digital platform. The other thing is we've pivoted more to to digital has been the rise in the buy now, pay later groups. So, in the past, we all remember, I used to manage the Sears card where you would get, don't pay events. But these buy now, pay laters have really made a seamless approach into the digital process that makes it very, very simple. So a lot of times when a lot of these retail transactions are moving online, now all of a sudden, instead of trying to put your credit card in or even having to get a new credit card offered to you, you've got a very seamless process to get the buy now, pay later. So the credit card is really being challenged by the lack of sort of that physical location spend that we've had in the past. And the last one is really around delinquencies. And, the key trend here is we have seen significant improvement when you kind of look at the 90-day stage. But we are seeing some early signs, and Becky will go into a lot more detail around sort of where that's coming from. But, deferrals really kind of helped hide some of these the problems as we went through the tail end of the year. But as these deferrals sort of go off, now we're starting to see a little bit of the strain. And particularly those people who were challenged prior to COVID have really sort of returned back to where they were, despite the fact that many of them may still be benefiting from the employment benefit programs. We're starting to see much more strain in those people. So again, the growth is really on the mortgage side. And again, we've seen really strong increases in house prices as the market has gotten stronger. Supply still tends to be quite tight in most marketplaces. It will be interesting to see as we go into the spring housing market whether or not listings really jump as people try to take advantage of these increasing prices. And so, people are really going to jump in here on the lower mortgage rates. We've seen the bond market selling off, so we know that mortgage rates have started to edge higher. If anything, that might actually expedite some of this activity because people are going to try and jump in. But the reality is we're coming off such low levels on the mortgage rate side, and in reality, you can still get variable rates at very, very low levels as well. So we may see a pivot, which could be a concern from sort of fixed to variable rate more as mortgage rates do start to back up a little bit. But we're still talking about, historically low levels that have really supported that marketplace. And as I said, when you look at the non-mortgage side, most of these categories have really sort of been challenged to really bounce back. Autos, again, is another one where we saw, that, like I said, a little bit of recovery very early on when the first shutdown sort of opened back up. But we've really stayed a little bit below 2019 levels now for some time. And so, we've got to see more of a recovery. We have to see people who have to get back into a car to get to an office. We do think there will be a strong recovery. But for now, most of the non-mortgage categories really have been struggling to get back onto the growth trajectory. And that really brings us to sort of the delinquency level. And again, part of this is just the benefit of having deferrals, which means it's delayed some people. And again, the fact that particularly at the lower end of the market, some of these SURE programs have actually increased people's income for a period of time. So we have seen a very good increase. We're starting to see it edge a little bit higher, particularly as deferrals come off. But, so far, we just have not experienced things that we have seen historically in any type of recession. If you kind of look at every category type, something like HELOCs is a great example where we're down considerably year over year from a delinquency. That was something that was a concern for us going into COVID. Like I said, as interest rates had gone up in sort of 2017, 2018, we started to see HELOC users start, showing some signs of fatigue there, and we started to see rising delinquencies for HELOC. The fact that it's recovered so much and sort of sustained that shows you there's been this great opportunity, and again, the lower rates are really kicking in to support that group. So we're starting to see a little bit of that, and I think Becky will get into some of why, and I think even James on the forecast outlook, we'll start to talk about where we're going. We don't believe this is something that's sustained for a while. At a minimum, we do believe we get back to sort of pre-COVID levels as we get towards the tail end of this year, particularly as those government programs start to get off the books. Bankruptcies is another interesting area where, again, we were actually getting some warning signs early on, particularly around consumer proposals, where we were seeing fairly strong increases over the last couple of years. We were noticing a lot of the early signals, like delinquency, weren't sort of predating these consumer proposals. And so, it was quite concerning how you were starting to see this disconnect. Not surprising when we saw the big decline in the second quarter, given that, again, bankruptcy trustees and courts and everything were closed. We have been surprised at sort of how slowly it's been recovering. We did think it would bounce back a little bit faster, that a lot of those people who took deferrals were probably just delaying the inevitable, but they have shown a little bit of resilience where it hasn't been quite as immediate, although, Becky will point to some things that will show those people who were delinquent prior to deferrals are really starting to show much more strain on the bankruptcy side. And so, again, coming out of a recession, we really didn't behave from a credit perspective anything like we would have seen in the past. We wouldn't have seen that the strong surge in mortgage, and we certainly would have expected higher losses, delinquencies, and bankruptcies, which, again, we do believe will start to come back, probably just to sort of pre-COVID levels. But it's been an interesting period, and I guess that this is what we call a recession going forward. Will make many of our lives much, much easier. So I'm going to pass this over to Becky Oakes, who's going to give us a lot more details about some of the key products. Becky?
Thanks, Bill. So as Bill mentioned, credit cards is really one of the products that we've been talking a lot about since the pandemic started. So we've seen quite a lot of movement in terms of usage of credit cards throughout 2020. And although we saw increased usage towards the end of the year, it still remains one of the largest impacts in terms of product-wise. Now, from a new credit card growth perspective, with all the lockdowns and some of the reduced need for consumers to utilize credit products, we did see a large fall in the volumes of new cards coming through last year. So you'll see that left-hand side chart. This is a new card volume on a quarterly basis. So this did start to increase in Q3, and we saw in Q4 that was up again another 10% compared to Q3. So we are seeing some movement in terms of that market beginning to pick back up again. In terms of who's actively looking for new credit cards, as you may expect, all the main groups are kind of lower across the same period in 2019. But in Q4, what we really saw was that growth coming through on some of the lower scoring consumers. So perhaps as they're starting to see some levels of financial difficulty come through, they maybe are starting to leverage credit card products again. We did also see a fairly large increase on the higher scoring consumers as well. So you'll see there quarter on quarter 18% up on that highest scoring group. Now, interestingly, the youngest group of consumers, the under 25s, we're seeing very little growth in terms of new credit cards from them. Now, as Bill mentioned, there are some new players in the market which could be contributing to that. So he mentioned the buy now, pay later group. So potentially it may well be that some of those younger consumers are perhaps turning to alternative ways of financing instead of taking out a new credit card. Now, the lenders, when we look at kind of what they're doing, we did see quite a bit of a change last year in terms of new credit cards and the limits that they are giving out on those new credit cards. So you'll see in that left-hand chart, this is the average limit on new cards, and you'll see that big drop coming through in kind of Q2, Q3 in terms of that average level. Now, we do sometimes see this during periods of uncertain economic periods. So, for example, if you look at that chart right to the left-hand side, this goes back to the last banking crisis, and we did see limits that were being given on new credit cards following that period. So we did see this huge drop in Q3 and Q4. It is increasing a little bit again in Q4, which is kind of some good news, but again, it is still down across the board. That right-hand table just shows that change broken down again by credit score band. So we are seeing that where lenders are starting to increase some of those average limits that have been given on new cards, they're really focusing on increasing that on the higher scoring consumers. So some of the market where you have individuals perhaps a little bit higher risk, they potentially aren't seeing the same access that they had previously. Now, from a consumer behavior standpoint on credit cards, we definitely saw some large changes in terms of how consumers were using cards over last year. So the chart that you can see on the screen, this shows the average credit card payment, which is the grey line, and we see the average credit card spend, which is the red line. So the kind of way to interpret this is that where that grey line is above the red line, that means that consumers were overall paying more than they were spending. So you'd expect to see credit card balances reducing. Where it's the opposite, so the red line above the grey line, it means that they're spending more than they're paying, and we would expect to see balances increase. So pre-COVID, consumers were already paying down some of their credit card balance. But what we did see in that Q2 period, which is when all those lockdowns came in, we saw spend really kind of drop, and that's where we saw some of the biggest credit card balance movement. So it was caused by consumers continuing to make payments yet not spending. Now, what we've seen since May and June is that it's really been fairly balanced. So we've seen kind of that spend payment ratio really kind of come back in line with one another. Now, towards the end of Q4 into December, you'll see that red line ticks up. Now, that's maybe not too unexpected because we're entering the holiday period, so there will be some seasonality in there. But again, we're starting to see balances start to increase again on credit cards as a result of that. Now, if we break this down a little bit further into the demographics in terms of who's spending and where, the main thing we're seeing is that younger consumers, since kind of Q3 and into Q4, we're seeing that they're the main area where we're starting to see that credit card balance start to accumulate again. So that chart you can see is broken down into age bands, and it's a spend to payment ratio. So what this means is anything above 100% means that they are spending more than they're paying. Anything below means that actually they're paying more than they're spending. And you'll see that blue bar coming through. They are the youngest age group, and they're fairly consistently in that third period spending a lot more than they're actually paying. So credit cards have seen a lot of movement, but they're not the only product where we kind of saw some changes last year. Now, auto lending, we did see a fair bit of movement. Generally with auto, it's fairly consistent in terms of how those new auto loans and leases are coming through. So that left-hand chart is new auto finance trades. Now, what we normally see is that in Q2, we have a seasonal high, which is really kind of where we see the biggest growth across the year. That didn't really happen last year because of the pandemic. So instead, we saw a lot of that auto activity pushed into Q3. And we also saw a drop in the percentage of new trades that were leases as opposed to loans. That right-hand chart, if you look at the orange line, this is the percentage of those new trades accountable to leases. So we did see this kind of shift in behavior a little bit. So we saw consumers pulling back a little bit from the lease side of things, and we saw that those new trades were really kind of pushed towards the back end of the year. Now, one of the other big movements that we saw on auto was really around some of the auto limits that we actually had in place. Sorry, this chart here. So this chart on the left-hand side, this is the average loan amount that we saw. And what we saw is that in Q3, we saw that amount really increase compared to what we'd seen in previous periods. Now, some of that we believe was driven by demand potentially exceeding supply. So, some of the manufacturers shut down during some of the lockdowns, and that caused some kind of reduction in terms of the actual vehicles that were available in the market. But that average loan amount did reduce down in Q4, so we saw that return back to kind of pre-COVID levels, a little bit more in line with what we normally see. And on the right-hand side, what we'll see is, again, broken down into the score bands in terms of who was actually taking those new loans and kind of where we saw some of that movement in terms of average loan amounts. Now, interestingly, the actual biggest increases we saw were on some of those lowest scoring consumers. So there may well be some pockets of individuals that actually potentially have those kind of lower scores actually taken on more credit as a result of kind of the period last year. If we look at the delinquency side of things, they really were on the rise before COVID happened. So that left-hand side is our severe delinquency measure. So this is 90 days plus delinquency. And what we're seeing is that before COVID happened, auto really was seeing some signs of stress in terms of a product and in terms of a market. So it was already increasing. Now, as a result of some of the deferral programs, although they weren't highly offered in the auto sector, we did see that the general effect of some of those deferral programs coming in, combined with some of the government programs, led to delinquencies reducing overall. So into Q3 and Q4, we kind of saw those continue to reduce. What we did see in Q4, though, is that, again, if we look at kind of some of the breakdown into the auto finance versus bank loans, where perhaps deferrals were more commonly used, we do see a kind of a uptake in terms of delinquency. So on that right-hand chart, that grey line is the comparable bank loans. So these are bank loans that are kind of between $5,000 and $100,000 limits, and this is where we try and estimate potentially they are being used for auto products, and we'll see that tick back up again. And again, that's really because some of those deferral programs reduce the delinquency level of those consumers, and as a result of them coming off those programs, some of them are starting to miss payments again. Okay, so if you move on to some of the secured lending side of things, as Bill mentioned, the mortgage market is really one where we've seen continued growth despite the impacts of the pandemic last year. Now, in Q4, we not only saw a 22% increase in terms of new mortgage trade volume when we compare to 2019, but we also saw the highest increase in average new mortgage amount since 2015. Now, what's driving this despite all of those headwinds of the pandemic, is a few things. So we have those low interest rates, and they've really done a few things. They've potentially helped encourage some consumers to renew or refinance their mortgage sooner than expected. They've actually helped a lot of consumers who perhaps purchased their home back in 2015, where we had huge house price increases and there was kind of a housing boom. A lot of those are coming up in terms of their fixed term period. So what we're seeing is that actually those consumers need to kind of renew or refinance potentially, and actually they're hitting a period where we have very low interest rates, so that's really helped to encourage them to do that right now. And then also what we've seen is a jump in terms of first-time home buyers. We've seen above average levels of growth on the first-time home buyer side of things. So they are starting to get their foot on the housing ladder. And again, those low interest rates are going to have helped potentially with that piece. Now, it's not all good news for first-time home buyers, though. So as we all know, house prices have continued to rise, and we are seeing average mortgage amounts in some provinces like Ontario or BC getting closer to $500,000. Now, that's great if you're on a low interest rate or fixed-term mortgage, but of course, the big question is going to be what's going to happen in 3 or 5 years when potentially interest rates could be higher, and those consumers are going to come up for renewal, which is a similar position to where we were 5 years ago, and actually the pandemic and the low interest rates maybe are actually helping those consumers out. Now, the biggest growth on the first-time home buyer side is for the younger consumers, so those 26 to 35-year-olds and the 36 to 45-year-olds. Now, what we do capture in first-time home buyers is the new to Canada population, and that's just because our definition of first-time home buyer is someone who's never bought a home before. So what's going to be really interesting when we start to look over 2021 is what's going to be the impact of perhaps reduced immigration last year into the credit market this year, and that's something that we're going to be focusing a little bit on over the coming months as we start to see, is that going to be having an impact, whether it's on the mortgage market or indeed some of the other products that are out there. Now, delinquency-wise, our severe delinquency measure, which is the left-hand chart, again, on mortgages is fairly stable. So we saw that drop into Q3 as those deferral programs took hold, and it's stayed relatively stable in Q4. But as Bill mentioned, what we're starting to see is early delinquency. So this is where a consumer has missed 1 or 2 months payments. That's starting to rise. So that right-hand chart is the 30-plus delinquency. So this is 30 days or more missed payments. And you'll see at the end in Q4, those upticks in terms of what's happening on the mortgage side of things. Now, again, it's still lower than perhaps we were prior to COVID, but it's obviously something that we are monitoring fairly closely. Now, with all that mortgage growth, what we've actually seen is the largest increase in new Heloc volumes in Q4 since 2015. So that left-hand chart, you'll see the year-on-year growth, and you'll see that big jump in terms of Heloc usage. Again, that's going to be heavily linked to some of the mortgages that are coming through. And when we look at that provincially, it is kind of BC, Ontario, Quebec. That's where we're seeing the biggest growth on that Heloc side as well. And as Bill mentioned, and this is an interesting one for us because we were closely monitoring Helocs prior to COVID because there had been some stress in that industry kind of back into kind of 2019 as a result of some of the interest rate movements. So this is an interesting one for us to keep an eye on over the next year or so. Okay, so let's dig a little bit deeper into the deferral population. Now, just as a quick reminder, I know we've kind of shared this with you a few times over the last year. There was over 3 million consumers, so that's around 11% of the Canadian population that utilised a payment deferral at some point of March last year. Now, almost 3/4 of those only deferred on one product, so for example, just the mortgage or just a credit card. But what's interesting is that 1 in 4 of those were already stressed, so there were signs of delinquency on their credit file before the pandemic even started. Now, potentially, this support mechanism was actually being utilised by some consumers, regardless of whether they were impacted by COVID or not, but actually to help them through that financial difficulty period. And actually, for some consumers, that's been really beneficial, and I'll kind of talk to you about that in a few slides. Now, in terms of who leveraged those programs, it was fairly widespread, but it was more so for those higher risk or lower scoring consumers. And although all age groups leveraged the programs, As you may expect, mortgages tended to be more on the older population just because a higher percentage have a mortgage, and those that kind of leverage things like credit card deferrals tended to be a little bit younger. But in terms of kind of the actual uses across Canada, that actually wasn't that even. So that left-hand chart shows you in orange the mortgage deferral rate and the grey is non-mortgage by some of the main provinces. Now, there were some real hotspots in terms of usage. So Alberta, for example, by far had the highest mortgage deferral rate, and indeed overall. And what's interesting when you start to look at some of those deferral levels is that we know that Alberta was actually seeing some signs of stress prior to COVID even happening. So we were seeing delinquency start to increase in Alberta beforehand. So we've also seen that some consumers leveraging deferrals on multiple products, they tended to be on the programs for longer. So where a consumer perhaps deferred on both a mortgage and a credit card, they generally were taking advantage for a lot longer period of time, and that's potentially because there was more financial stress coming through on those groups. So actually really understanding how some of those different deferral behaviours appear in your portfolios can actually be a great indicator in terms of, you know, where there may be pockets of stress that perhaps over the coming months from a strategy standpoint you should be thinking about. Now, the vast majority of those deferral programs were coming to a close towards the end of last year. So on the chart here, you can see the active volumes of deferrals, and you can see that real drop-off into October, November, and December. Now, the good news is that the vast majority of consumers, as those programs started to end and they exited from them, we did start to make payments. So we saw 99% of mortgages coming out of deferrals were making payments, 97% of auto installment loans. Credit cards were a little bit lower, so 93% started making payments, which means there was a population there that didn't revert back to being able to make their regular payments. And that's a really interesting one for us because credit cards, they tend to be the first product where you see missed payments when someone becomes financially stressed. So it's the first one where that early delinquency comes through on. So with all of these moving parts, I guess the big question really is, can we tell who is actually in a worse financial position or better financial position? So what we've looked at on this slide is we've looked at consumers exiting those deferral programs, looked at kind of what was their position before COVID happened, and then looked at what's happened since that point. So this is kind of a population of they've left those programs now, and what we saw is, again, as I mentioned earlier, 23% of those, before they took the deferral, they were already delinquent. 77% were actually up to date, current, in a good position on their credit file. When we look at what's happened as they've left those programs, on the prior delinquency side, a quarter of those have actually come out and started making payments. So they were delinquent, they've been through the deferral program, and now actually they've started making regular payments back on all of their trades. So actually they're in a much better financial position than they were prior to COVID. On the flip side, if we look at those who were kind of current or up to date before COVID, 6% of those have now become delinquent. Now, when you actually even out all of those numbers, what you get to is fairly balanced. So we have around 140,000 consumers were delinquent, now they're not, and around 125,000 were fine, and now they're delinquent. So far, we are seeing some swap sets in terms of movement around perhaps consumers that we wouldn't expect to be delinquent that now are, and we've actually seen a much improved situation for kind of many other consumers. So it's kind of a fairly balanced, but it is kind of moving around a little bit in terms of who's doing what. Now, in terms of geographically, when we look provincially, where we see those delinquencies coming through, again, we are seeing it in Alberta, we're seeing it in the Atlantic provinces, and again, there potentially was some stress already prior to COVID coming through. So yeah, those areas still remain kind of high up on our kind of watch list in terms of what to keep an eye on. So just to break this down a little bit more on the deferrals in terms of on a product level, what I've got on the slide right now, this is the credit card trades. So these are credit card trades where a deferral was taken and then they've exited. So the grey box is almost where that deferral started and kind of as it's kind of exited out of that. And the lines on the chart are the early delinquency rate, so 30 days delinquency. Now, what you'll see on the red line, this is the entire deferred population. And what you'll see is that as we are exiting those deferral programs on credit cards, they're actually coming out at a higher delinquency level than they were prior. So we are seeing more early delinquency come through compared to where they were prior to that. The green dotted line is actually the non-deferral population. So this has actually been fairly static or actually improved its position since COVID started. What's interesting when we look at this in terms of at a kind of a subgroup level, we are seeing seniors tend to have the biggest increase. So we're starting to see a population on the senior side where they're actually seeing a much higher increase in that delinquency than perhaps we were expecting. And I know that there tends to be a lot of questions around, well, why is that? Some of these seniors perhaps that they weren't impacted by job losses. Inflation perhaps plays a role in this. When you look at kind of things like food inflation, that tends to be above average, and some of the senior population, perhaps, if you're not seeing much movement in terms of your income, that can impact them. But it's definitely one that we are definitely keeping an eye on. So that's credit cards. Also, installment loans tell a similar story in terms of people exiting deferrals. The good news on this side is that their delinquency rates aren't exceeding where they were prior to COVID, so they're kind of returning to similar levels, but we're not seeing that big jump like we saw on the credit card side. And then if we look at the mortgage side, that is starting to come through, but mortgages tended to have a lot longer deferral periods. So it's quite early to be seeing some of that delinquency come through. We are seeing it start to increase, but really it'll be after Q1 when we'll see what the real impact of that is. Okay. So there were a few questions that came out of our last webinar around score movements. So last year we did see consistently that scores were increasing for consumers, and that was driven by a few things. So we had reduced balances, reduced spending on things like credit cards. Because consumers weren't applying for much new credit, that obviously helped their credit score. And the deferral programs and some of that increased payment behaviour meant that we saw much lower delinquencies. So that really kind of increased the scores in kind of Q2 and into Q3. What we're seeing in Q4 is that has flattened, and actually that's starting to reduce down a little bit towards the end of December. So you'll see on that table just what's happening with kind of the average scores. So it is dropping back down again, but it's kind of not yet back to kind of pre-pandemic levels. And then finally, just a quick word on insolvencies when it comes to deferrals. So we know insolvency rates have been a lot lower during the last few months, and we are starting to see those volumes creep back up again. When we look at deferrals and insolvency rates, we do see that consumers who took a deferral have 5 times the insolvency rate than non-deferred. And if you break that down further, again, into those two groups of who was delinquent prior and deferred and who was delinquent or not delinquent prior and deferred, you see that obviously the delinquent population is much higher still. So on those bar charts, that red line is where you had consumers taking a deferral, and then also they were delinquent prior to COVID, whereas the orange is the same but non-delinquent prior. So it's just kind of, again, to kind of keep a bit of an eye on in terms of we are seeing some of these pockets of stress start to come through. It's still relatively early, and as Bill mentioned, those government support mechanisms that are still in place are really holding a lot of this still together, I think. So I think the next few months are really going to be quite interesting. So I think that's probably a good point for me just to take a pause. I don't know if we have any questions that have come through.
So we have a question around bankruptcy. So either Becky or Bill can answer this. The question is, considering that a lot of the direct government support programs have been extended for Q2 and Q3, what do we think is going to be the impact on bankruptcy trends in 2021?
Bill, if you want me to take that. I absolutely think that, with them being extended is really important. This is all about balance to me. So, the economy is not yet back to where it was. We know there are still a lot of small businesses that are really struggling. We're seeing a lot of, even from the larger chains of businesses are actually still, really challenged in a lot of key industries like the hospitality and restaurant industry. So, having those support mechanisms extended is definitely going to help in terms of keeping consumers in a good place from a financial standpoint. The real challenge is going to be when those support mechanisms finally end. Is it going to be at the point at which the economy has recovered to the same degree as it was prior to COVID? Now, if it is not quite at the same level, then potentially you might see those insolvencies start to increase. We might see delinquency start to increase. If it's in at a time where actually the economy has recovered to a greater extent and some of those businesses have managed to restart again, then the impact's going to be a lot less. And I know it's not a great answer. It's a if but maybe. But it really is kind of getting that balance right. I don't know, Bill, if there's anything else you would add to that?
No, I think that's the point. I think what we've seen is it's, the benefits and things that are sustaining people, but we are seeing a sort of default back to the pre-behavior. And so, I think once the benefits are kind of rolling off, we will see a return fairly quickly to sort of pre-behaviors.
Okay. Any other questions, Solomon?
Yeah, so we have a question around credit cards. So could you explain the disconnect between younger consumer taking more credit card debt but less new accounts for younger consumer?
Yeah, that's a great question. I mean, obviously, if they're taking on more credit card debt, that's mainly just a sign that they obviously are using the card. I do think those buy now, pay later are probably impacting perhaps the new credit card side of things. I don't know, Bill, if you'd agree with that, but I imagine there probably is some level of kind of them switching to alternative methods, yet at the same time those that already have a credit card are still going to be using it. I don't know, Bill, any thoughts from you on that one?
Yeah, I think there's a couple elements. I think, again, a lot of the acquisition is a physical location, right? You're standing in line at a store or whatever, and they're asking for you. And a lot of the sort of the motivations for new cards haven't been in the marketplace either. And so I think what you've had is a lot of people who aren't looking for anything new and leveraging what they've got when they do their online spending. And then in some cases, again, these buy now, pay laters are so well integrated that they're just taking kind of those options where they may have said, I'm getting close to a limit on a credit card. And so I think there's a number of factors, but the lack of physical location and the fact that they haven't been significantly growing their credit card debt, so they're at balance or at limits where they need new cards. I think a lot of the motivation to get a new card is gone, although they're going to use it because a lot of their spending has gone online.
Yeah, and I think it also could be that the chart we showed was that spend to payment ratio. So it's not necessarily that they're spending more on a credit card. It could just be they're paid less as well. So, it may also be that side of it. So potentially that could be the other reason why we're kind of seeing that kind of disconnect a little bit, because maybe the actual payment side is reducing. Okay. I know we have a few more questions coming through, but I do want to make sure that we give James some time to go through kind of the future-looking view. So, James, maybe if you'd like to take over and you can talk to us a little bit around kind of what Moody's sees in terms of what might be coming over the coming months.
Yeah, my pleasure. Thanks, Becky. So, as Bill and Becky both said, I'm from Moody's Analytics, and we put together a forward-looking view, bringing in our economic scenarios to a specific forecast for consumer credit. And I've pulled some of those things that I think are interesting together for this presentation today. So first of all, just to kind of set the stage for mortgages, as we look back over the last 5, 6, 7 years, we've seen steady house price growth. In some cases, that growth has been more than steady. It's been red hot. And that's kind of come and gone over few years, and right now it is red hot. But also right now mortgage rates are low, right? So on this chart I'm showing here, we have the house price index in green. It's percent growth versus a year ago. That's on the left axis. So you can see, as I'm sure most of you are aware, we're in kind of a boom period for house prices. This is at the national level. I'm sure you're also aware that the mortgage rate is very low right now. So you can see in the blue line there, right at our current period, we're at historic lows, and Bill kind of spoke to this early on in this webinar. Now, it won't happen right away, but interest rates will come up, and so mortgage rates will come up as well. They'll stay near these low historic lows for the next little bit, but will gradually start to increase. And as you can see throughout history, these two series have been inversely correlated. So as we start to see the mortgage rates come up, commensurate with the increase in the bank rates, we'll start to see house prices drop as well. And they'll come back down to, or house price growth drop, excuse me, not the actual level. It'll still stay growing. And it'll come back down to this previous kind of bottom where it was just slightly growing at the national level, so 0.5%, 1%, which we see in 2018 and 2019 there. Now, how does this connect to consumer credit? I pulled our forecasts for subprime, which is roughly 540 to 620, and prime, which is 680 to 740 as we've organized the data. And again, we have two series with different vertical axes. Subprime balances on the left and prime balances on the right. And this is the outstanding balance for mortgages, right, in billions of dollars. So subprime has been trending down for the last number of years. It is, a tenth the size of prime, but it's trending down. And we'd expect that to kind of level off and maybe even start to grow at the tail end of our forecast period out into 2024 and 2025. Despite the increase in mortgage rates and the decrease in house prices, our forecast shows zero change really to the growth in prime outstanding balances for mortgage, which I think is supported by some of the things that Bill and Becky were talking about. We've seen really strong performance in mortgages, not much deviation from the past over this previous year. And so we see really a strong outlook for growth in outstanding balances for mortgages. Maybe the matter that is more top of mind, though, are delinquencies and defaults. So let me explain our economic scenarios first before we dig into this one, and they'll be consistent on this slide and the next slide. So our baseline scenario is the most likely path for the economy, right? So based on where we are today and everything that we know, there is a very kind of likely trend for what's going to happen. What we call our S4 is our severely adverse scenario. What that means is, this is historically bad. So it's almost like, the previous recession we were just kind of coming out of now, that is the type of recession that we're trying to model with our severely adverse scenario. Another way to think about it is, if we look at the kind of distribution of outcomes, it is worse than, only 4% of scenarios. So. Oh, sorry, I just see a message that I'm cutting out. Is this okay now? Please let me know if it's... sorry. Okay. So back to this forecast here. So, we've just gone through some of the mortgage details of the kind of recent performance there, and you see that comes up here as well. We've had a huge dip in 30-day delinquencies coming through here. And, as we move forward, as deferral programs start to dry up, as government assistance starts to dry up, in the 30-day forecast, which we have in green, we see a kind of gradual kind of increase. And, at the end of 2021, a real pickup here where the programs are actually starting to fall off. Now, once they've completely fallen off, we go back to some historical levels, right? What's interesting here, I think, is the change with the S4. So remember, S4 is a really kind of dire scenario. So imagine this kind of third wave that we have for cases with COVID becomes really, really bad, right? And again, we have shutdowns, job loss. We start to go back into a recession that we experienced like last, May, June, July. And here we see delinquencies pick right back up. There is some government assistance in our forecast here, but not enough to kind of counteract those negative effects. So that is kind of like the worst case scenario that we could imagine given the current state of the economy and consumer credit. For cards and auto loans, the pattern here is kind of similar, but it evolves at a much quicker pace. So you do see a kind of low level for the next quarter or two, but whereas the mortgage delinquency rate picks up end of 2021 and then returns to normal in 2022, we see that happening before, maybe a couple quarters, 3 quarters before for both auto and cards. Tracking the historical pattern of trouble showing up in those asset categories before it shows up in mortgage. For defaults, again, this is for mortgage, a similar pattern, but what the reason I wanted to show this slide is because the downside risk is really apparent in our downside scenario here. So comparing this to the previous slide where the delinquency rate was 2 or 3 times higher under our very dire scenario, our S4 scenario, than under baseline, here we see almost 5 times high in terms of the default rate for mortgage. And if I were to compare this to auto or cards, those would have a similar jump to the 2 or 3 times that we have for the delinquency rates. So this is by far our kind of biggest risk if we were to enter this, albeit unlikely, but there is some historical precedent to our severely adverse scenario. So just wanted to highlight here a kind of dire situation. If that were to arise, we see a lot of risk in mortgages under that S4 scenario. But under the most likely scenario, our baseline scenario, defaults will pick up a couple quarters, maybe 1 or 2 quarters, after the return to the historical levels in the 30-day rate, right? So end of 2021, early 2022, 30-day delinquencies go back to normal, pre-recession normal for mortgages, and then a couple quarters after that, the default rate returns in kind. So again, consistent with that, removal of government assistance and everyone kind of finishing up their deferral period. So that's it for me. Story that I had some mic issues there, and if I have to clear anything up, I'd be happy to. But if not, back to you, Becky.
Thanks, James. So I think there was a question that came through around any particular credit worries arising from housing bubbles across many parts of Canada. I don't know if you've got a view on that, or maybe Bill.
Yeah, so I mean, I guess by bubble we mean very high price growth, right? The worry with a bubble is that it pops, and so right now we've seen no indication, at least on our end. Maybe Bill has a different opinion about those house prices dropping rapidly, right? So on that first slide that I showed, we see at least at the national level a kind of gradual decline back to 0 house price growth for a little while, but no actual decline in house prices themselves. So not much fear of a bubble bursting on our end.
Yeah, I agree with James. I think there's a couple of factors, right? So if interest rates when interest rates start to go back up, they're probably not going to be kind of radical, massive jumps, and that will be a key determinant. The other thing to keep in mind is, despite the fact we've had a pretty strong market, it's come at a time where immigration has actually been relatively low because of the pandemic. And so the fact that, the federal government has announced once we get through this, we're going to be at a point where somewhere between 400 and 450,000 new immigrants a year will mean a really good sort of demand side to the marketplace. And so we don't see any radical sort of increases or decreases in house prices. I think the one thing to watch for is sort of local market conditions. We've seen fairly rapid, significant increases in house prices in sort of out-of-way places that you don't think of. Tillsonburg, places like that, Prince Edward County, Belleville. And so they may see a little bit of a correction, but there won't be a mass increase. So I think a lot of the support systems are there that we don't see a big drop-off in the mortgage industry and housing in particular, unless we see some kind of radical shift in terms of the interest rate scenario. Any other questions, Becky?
Yep, apologies, Bill, I was on mute. With high unemployment, rising delinquency, and government subsidies coming to an end, what is causing inflation expectation to rise, e.g. the US 10-year rate is now back to where it was before the pandemic?
Yeah, so I think there's a couple of things, right? I think the idea of government subsidies going away is because there's an expectation of a fairly rapid, significant rebound in the economy. And so I think there's this notion of really strong growth that will come in the back half of this year. And then more importantly, and if you kind of go back to one of the early slides, there's a fairly significant growth in excess savings, which means people have money to be able to spend. And so, I think there's this assumption of that really strong surge in economic activity, people unwinding this excess savings, that you really get a lot of demand driving retail, and that will drive prices. I think there's just the other element of that there's, a year's worth of revenue loss for a lot of companies. If you think about travel, where there'll probably be very strong demand, got to make up for lost time. So there's a few factors that where we believe there'll be a strong recovery will really drive the potential for increased inflation, which is really what the bond market's reacting to.
Okay, thank you, Bill. So I am conscious of time, so just before we kind of leave, I guess, we know there are a lot of uncertain times ahead of us, and as we said throughout the last year through our webinars and all our credit trends, segmented strategies are really highly recommended when looking at your customers and your portfolios through this period. And, as we're starting to see some of those early delinquencies start to come through, making sure you're having the right conversations at the right time and you have plans in place to manage that is going to be really important. There definitely are still those growth opportunities, but having that better understanding is really going to enable you to pinpoint kind of where growth is viable as opposed to where there could be some incremental risk coming through or some pockets of stress coming through. Now, one last thing, just before we close off, I know James, unfortunately, didn't have time to do, a lot of a deep dive into some of the other outlook for other products and things. We do have a joint webinar with Moody's on the 24th of March, which is going to be focused on the Canadian consumer credit outlook. So they're really going to be digging deeper into this at a more granular product level. So I do highly recommend joining that. I think in our material that we have on 24, there should be some links and things for you to be able to register for that, but that definitely will be an interesting one in terms of what may happen in the future. If we didn't get to your questions today, we will do our best to kind of follow up with you after the session. But from my side, thank you, James, for joining us today, and thank you, Bill, for the economic recap that you did, and thank to all of you for kind of joining us for the session.